Welcome back to Lamb's Cryptoverse, or maybe I should call it the Macroverse, because today we're going to talk about a drill down of the one big mistake I made, and that was timing. I said that rates would be going down by now, and I expected a deeper inversion in the yield curve. I mean, we do have an inversion. I believe the 10-2s are about 40 basis points, but I thought it would be worse. And I thought there would be a bigger inversion with the 30-year versus the 2-year. So why isn't this happening? Why? Because I have to be honest with you, I deserve this. I did not do my research. I'm pretty good with my indicators. They say you can't time the market, but I spent years, actually decades, going over history, seeing what happens when this happens, when that happens. Basically, I checked my indicators. I back tested it and forward tested them. But when I said early in the year, this is back in January, February, I thought that rates would be going down by now, and I especially thought by the very least that the 30-year interest rate would be lower, much lower than it is now. So I did finally, after all these months, I did some research. And it's not easy to find information on this, but I did find something. And this is from Deutsche Bank via CNBC. And you could see here what they showed you was rate hikes and recessions. Basically, they showed you the duration of the federal funds rate hikes. And they showed you when the next recession hit. And most importantly, they showed you how many months it was from the beginning of the Fed funds rate cycle, so when they started raising rates, to when the next recession started. And by golly, I thought it would have been like 6 months. No way. And if you look here, starting in 1957, I'll give you the first example. The Fed raised rates for 28 months, started in actually April 15, 1955. And the next recession wasn't until August of 1957. That's 28 months. So I'm thinking that must have been an exception. That was a really long time. It must have been only 6 months. No, it wasn't, and that was not the exception. And they've got this, they supplied this table here going all the way to 2006. And I even went to 2008 on my own, and it did take a long time for 2008. So let's see the data. The data says that the average, and this is on the bottom here, I'm highlighting it, trying to highlight. Here we go. We have 22 months of duration since the Fed raised rates, first starting raising rates. And the median or middle number is 14. So by the very least, you need to expect over a year of Fed raising rates. And we just started raising rates in March of 22, right? And now we're in October. October's not even done. So if you take October being 10 as a number and March being 3, 10 minus 3 is 7. So we're only halfway, if you look at the median recession, we're only halfway through the Fed rate raising cycle. And the San Francisco Fed, maybe she was right, Meister, she said, we're just going to keep raising rates. And all these people, I criticize all the Fed governors because they keep banging away and saying these Fed talking points. I feel like they're being strong-armed to say the same thing over and over, that they're going to keep raising rates. But maybe they're right, because the average rate cycle is 22 months. And like I said, I expected this recession to start beginning soon, within months. But according to this, if you look at the title here, time to next recession in months, the average months are 41 and the median months are 33. I just got a red flash here. Breaking news, the Dow dropping 600 points and NASDAQ's down 3%, and that's for the day. And this is because of the labor report, which it was stronger than expected. What does that mean? The Fed's going to keep raising rates. So going back to this, so by the very least, I made a mistake in my timing, because by the very least, it looks like the Fed, the recession is not going to begin until at least 33 months, or if you're looking at average, 41 months after the first rate hike. So the first rate hike was in March of this year, March 22. So if you're looking at, I don't know, 33, 36 months, that's 3 years. So I don't think that's going to happen. And I'm not trying to ignore the data, but this economy is the most financial leveraged economy probably in history. The total GDP, I'm sorry, total jet to GDP is nearly 400%. So that's why I thought that we're going to hit a recession soon. But if you remember, and if you look at my videos below, the ISM hit what I call the tipping point. The ISM PMI index to me was one of the most important economic indicators that came out. It's the canary in the coal mine. And that PMI index is indicating we are going to have a recession sooner than later. So maybe we don't have a recession 6 months after the Fed first raised rates. But if you look at anecdotal information, we already saw one that came out today and yesterday with Samsung and AMD and Advanced Micro Devices saying that revenues are going to be much lower than expected. So if you look at that data alongside the ISM data and the FedEx data, right? 2 weeks ago, I think it was, FedEx said that we have an impending recession because they're seeing shipping volumes go much lower. And as we all know, FedEx is a bellwether for the economy. So just to reiterate what I said, I was wrong that rates would not invert or go down as quickly as I thought they would. But this, because of this table I'm showing you here from Deutsche Bank and CNBC, but I think it's going to be quicker than 41 and 33 months respectively, average and median, that we had in the past. And one last thing, what I did is I charted the Fed funds effective rate since 2003 to get more recent data and the real gross domestic product. And you can see even in 2008, it took a while between the top of the Fed's fund rate, that's November 2006, until the economy hit a recession. That was February, around the first quarter of 2008. It took some time. And what I did was I also looked at the 2-year rate because many would argue that the 2-year rate, and this is the constant maturity 2-year rate, is a good indication of where the Fed rate's going to be or the terminal rate's going to be. And if you look at it, it looked like it topped in June 2007, but we didn't get a recession until the first quarter 2008. So if you look more recently, you've got one of the biggest increases and let's go back in the Fed funds rate. We got one of the biggest rate hikes in history. And then you see the same thing. If we go to this is the 2-year constant maturity. You also see we went from about 0 to what we have now of about, I think today we're about 4.3%. So this is one of the biggest increases in history. But what you also see is that the economy is already in recession. Albeit, I don't call this a real recession. This is a technical recession because this recession, what we're seeing recently, was affected by inventories. But either way, we already have a slowdown in the economy, much slower than we had in previous rate hiking cycles when the Fed was raising rates as the economy was strong. This time around, the economy is not strong. Even if you adjust for inventories, the economy is still not strong. So that's about it for today. So I wanted to say is I made a mistake predicting a sharp inversion in the yield curve and predicting lower long-term rates like the 30-year rate and the 10-year rate. Why? Because I didn't go back to history. And remember, history tells all. You got to do your homework. And I apologize for that, but I think that we're still going to get a recession sooner than later in the next few months because the economy is already weak and we're already seeing canaries in the coal mine, such as a PMI index. Well, thank you all for listening, and please check out our other videos below. Bye-bye.